Hi, everyone. Good afternoon. As you know, we love to answer everyone's questions, and we get quite a few. So today we thought we would concentrate on some of the mortgage questions that we've been getting. And so we decided to bring in one of our very favorite people in the whole wide world. This is Caz Korowicki with Metro Advisor Group. And he's not only saved us many, many times, in our transactions, but also is extremely knowledgeable. He has many years of experience in the business, and we're thrilled to have him. So we want to welcome Caz.
Thank you very much for having me. I look forward to your questions.
All right, well, let's get started.
Okay.
Our first, and all of these questions, by the way, were sent to us from buyers or potential buyers that, are so interested in all of these words and phrases and things that are used, and they have no idea what they mean. So
yeah, actually, I got your list, and most people, those are the questions that most people ask. So why not do it here so they get the information ahead of time?
Absolutely. It's easier to get it from someone that has all the knowledge that you do. So our first question that we were asked is, what is hand money or earnest money?
Basically, it's the money that's given up front. The word earnest pretty much tells you you're making a serious commitment, and you're telling the seller that, hey, I want your house, and here's my good faith money, here's my hand money, here's my earnest money that I want to buy your house.
And we get asked a lot of questions about hand money, including, how people can potentially get it back. And we can go into that in another segment, but hand money, it can be returnable. So people don't have to worry that they're never going to see it again.
Yeah, it's the deposit that says, hey, listen, I want your house. Here's my money. Hold your house. And I'm serious about what I'm doing.
Very good. How can buyers get gift money and use it towards their closing costs? We do get that question a good bit.
Gifted money comes from relatives, which are parents, grandparents, siblings, or a fiance. That is it. In the mortgage industry, it can only come from that group of people.
So, Caz, what you're telling me is, if I have a really close friend, obviously they're a close friend if they're going to give me money, that wants to gift me money during a transaction, that's not going to work.
Yes, once again, it's what you have is it's a family member or a relative. So a good friend does not fall into that category.
Okay, perfect. Just thank you for the clarification.
Yes.
Caz, what in the world are points?
It's a good question. That one comes up a lot. Basically, points are the cost to a rate. The easiest way is just to put it as let's give us an example. One lender has 3.75, and it costs you a point to get it. If your loan amount is $100,000, that's $1,000 to get that rate of 3.75 with that lender. You can go to another lender, and the other lender has a half a point to get that rate. That's a half a point, which is $500. So points are associated with the rate. In some cases, they use the term par. Par means there's no points to get the rate. You're getting the rate that's being offered, if
Okay.
that helps.
No, it definitely helps, because I think points can be confusing for people.
Yes, you can buy a rate down. And what that simply means is, if I want to get to 3.5, there's a cost to get to 3.5. But that cost can be expensive. Is it worth it? Will you make that money in the long run? A good loan officer will do the calculation for you. It just had one where a person says, hey, I'd like to get this, but it's going to cost them a lot of money to do that. So you just do the division, and it would, for them to break even, it would take them 220 months.
Right. So they had to decide that they were going to stay in that house for a very long term in order for it to be worth buying the points.
Yes. So points are every institution is different. So is the rate that you're getting going to cost you points? That's going to be your decision and your discussion with your loan officer at the time.
Caz, can we talk a little bit about what the difference is between a pre-approval, a pre-qualification, and being underwritten? and not necessarily in that order, but what are the, you hear all three of these terms. Can you explain a little bit about
Yes.
them?
It really comes down to the verification of the information. So a person who goes online or a person who calls a loan officer like myself, they'll be asked the questions online. You'll input you'll volunteer the information. The information has never been verified. That's called a prequalification. You're being pre-qualified off of the information given. Once you turn those documents in, you're looking at a pre-approval, because now the information is verified.
Okay.
So underwritten is taking it a step further. You're taking it to a bank, and a bank has a person there called an underwriter. They're a licensed underwriter, and they're going to look those documentations over also. And then they're going to say, yes, my bank will do this loan for you, based off of the information given.
It sounds to me like, and this is just me talking, clients of mine that have gone online and answered some questions and input all their own information and had a pre-approval presented to them, which they present to me, there's a possibility that should get a second look by a loan officer that can pre-approve them and actually review their documentation.
Well, there's really no
That's safe?
guidelines. Yes. And there's really no guidelines. Big lending institutions will put these websites out. Again, the only way I can reiterate it is you have this pre-qualification letter that nobody looked your paperwork over. Nobody looked over your W-2s. Nobody looked over your pay stubs. Nobody looked over your bank statements where the money was coming from. So is a pre-qualification good? Sure. Is a pre-approval better? Yes. Is an underwrite and a commitment better than that? Absolutely.
Okay, great way to explain the levels of these things for folks. What about PMI? What is it, and why do I have to pay it or not?
Yes, PMI, private mortgage insurance. Basically, it's associated with a conventional loan. When you're buying a house, how much money are you going to put down on the house? The PMI is going to be based off of that, unless you put 20% down. If you put 20% down, so the purchase price is $100,000, you put $20,000 down, you don't have PMI. Private mortgage insurance, that's part of your payment.
So, Caz, I didn't ask you, I gave Caz some of these questions earlier, but I didn't put this one in, but I'm going to ask because I think so many people have a misconception about this. Someone can definitely purchase a property for less than 20% down, correct?
Correct. So going back to the PMI, the private mortgage insurance will be based on how much you put down. So if you put 3% down, PMI is going to be more in that payment. If you put 5% down, it's going to be less than the 3%, but a little bit more than if you put 10% down. You put 20% down, it's not a discussion. There is no PMI.
Got it. Caz, what's the difference between a mortgage banker and a mortgage broker?
The difference is the mortgage banker is going to be responsible for the loan that they close. A mortgage broker also has a responsibility, but they're going to go through a different banking institution. The banker holds their own mortgage. The broker can go and shop that mortgage at other banking institutions.
Well, we don't have any more questions at this point, but I want to thank you so much, Caz, for making the time. I know how busy you are. So it was so very kind of you to get on a call with us today and answer some questions. And we're going to put your contact information below. So if people have more questions, they can reach out to you directly, or if people want to submit questions for us, we'll do this again. Would you be willing to come back?
Sure. I had fun. It was what I think is very valuable for the folks. Any way we can help out, any way we can make it easier. That's just my motto, make easy.
I want to thank you again. It was great having you and having you answer all these questions. You're the consummate professional and the kindest person in the world. So thank you so much.
Oh, I thank you. Bye.
Bye. Hi, everyone. Thank you so much for joining us. If you've joined us for our previous section where we had some mortgage questions, we have Caz Korowicki back with us again from Metro Advisor Group, and we had a lot more questions. So we wanted to get him back in the seat to answer all of these great buyer questions that are really, really helpful and useful for people that aren't quite sure what to do. So welcome, Caz.
Thank you. Thank you. Thank you for having me back. I had fun the first time.
Oh, well, good. We'll keep you busy again.
I look forward to it. Okay.
What do you think interest rates will look like as we roll through 2022 and beyond? I'm listening.
Well, we could discuss that on my yacht. If I was in that industry, I would definitely have a yacht, and we would be discussing where the rates are going to go into the future. Right next to my island, by the way, I'd have it anchored next to there. I wish I knew. I can tell you this, and this is just from reading and information that we get. Rates are going up. They're not going to go down. It all has to do with the market. If you want to see where rates are at the time, Freddie Mac has a site that you can go to Freddie Mac, and they basically will publish what the national interest rates are for the week. Other than that, they're moving up.
So if people are in the market right now, it's probably not going to behoove them to hold off thinking that rates may potentially go significantly down.
That is correct. I mean, if you're in the market for a house, now's the time to get into the market with the rates being lower. But again, I couldn't tell you where the rates are going to go. So rates right now, even if they go up, are traditionally lower than they have been over a long span of time. Money is cheap now. Now is the time to buy your house.
Agreed.
If you're going to buy a house.
I think several houses ago, I got 7% and I was very happy about it.
That's correct.
So it just shows you the difference in timing.
Yep, it's the times.
Okay. Next question for you. What is the difference between my rate and APR?
It's a great question. The rate is what your payment is going to be based off of. The APR is your shop rate. So in other words, your APR will never be the same as your interest rate. And when you see advertisements for an interest rate, you should see someplace on that same advertisement what the APR is to get that rate. APR is always going to reflect what the cost of that loan program is going to be to you. An example, going back to the 3.75. If you have 3.75 and the APR is 3.99, that's a good APR for that rate.
There's not much room in between the two.
Correct. You'll see some advertisements because I know that Kelsey had asked me one other time that, and you've asked before, you see this low interest rate, how can they advertise it? Well, take a look at the APR, because what you're doing, and it's going to go back to the other question, is you may be buying points, you may be paying points to get that rate, and that will be reflected in your APR. Your APR will show it. It'll be high. It'll be a point. It may be more. But APR is your shop rate, and that's the reflection of the cost with that institution for that rate.
Okay, great explanation. Thank you.
You're welcome.
So another question they had was, what is the difference between FHA, VA, and conventional loans? What are the advantages and the disadvantages?
It just depends on the person. VA, FHA, and USDA are what they call government loans. Your conventional are insured and backed by and guidelines by Fannie Mae and Freddie Mac. Credit scores are very important to determining what your interest rates are going to be. Three things that go into it: credit, income for a debt to income ratio, and then equity. How much money are you putting down? Your Govy loans or your government loans, FHA, USDA, and VA, are loans where a lot of people, if they don't have their 20%, will look at, or if their credit score is a little bit low, they'll go over and look at. They're tougher on appraisals. So you have to take a look at the house. You have to bring the house into the sequence because the house is going to be part of the transaction. In today's market, conventional is more acceptable to the seller because the sellers want to make sure they can get their house sold. So they're accepting the conventional loans. So with conventional, you're basically looking at, you can do it as little as 3% down with a conventional loan. And it really is, overall, when it comes down to the payment, those are the things that a good loan officer will calculate for you and where you would fit in as a borrower.
So it's very individualized.
It is. It really is. You know, a person who has a great credit score may not have a lot of money to put down. You know, in that situation there, the programs offer different aspects to them on how we can get that person to come in. So a good loan officer is going to look at the situation of the borrower and fit them into the best loan for their situation.
So, Caz, how can someone qualify for a conventional loan? Because that seems, at least on my end of the spectrum, probably the most likely chance of having your offer accepted.
There's a lot of things that go into it. The best way is to talk to a loan officer because the pre-qualification online is not going to tell you how you fit into a conventional loan or not. What loan fits you better? A loan officer is going to be able to do that than look online. It's kind of like, okay, you have this thing, this pain that hurts, and you're going to go online to find out what it is, or go to a doctor and find out what it is. That would be the easiest way to do it.
Kelsey and I have our own beliefs on what to do about that. I got you.
Yeah, talk to a loan officer. They'll put you in that best one.
Perfect. Okay, this is a good one. Caz, are there costs that buyers should be watching out for when they're researching lenders? Like, what are the big things that they should be looking at?
This goes back to your question originally on the APR. What you're looking for is every bank has costs. They have administrative fees. They may have what I call little junk fees. That's going to be reflected in your APR. So that's the reason why you have an APR. The APR will reflect what the cost of that bank is.
So to that point, if a buyer is looking at a particular property or they want to start looking at properties, and they can reach out to you and you can talk them through all of this information and you can give them some cost sheets, correct?
That's what we do. You want to know what this thing's going to cost you, what this new project, what this new house is going to run you, it's going to cost you. That's what we do. We give the cost sheets. The cost sheets will have the APR. If you get a pre-approval, a lot of pre-approvals do not have APRs on it. They don't even have interest rates on it. So once again, if a person is serious about buying a house, they really want to talk to a loan officer. That's going to help you as the realtor. It's going to help them know what they need to do. Do they need to ask somebody for gift money? How do they know unless they talk to somebody?
Kelsey and I talk about this all the time. People are under the misconception that all they need is down payment. And I'm like, oh, no. Yeah. There's a lot more to it than your down payment.
And it's funny because I spend a lot more time on the phone with folks like that than I do with people that, you know, see programs like this or talk to you. You know, so it's really about preparation. It's the biggest item that you'll ever buy. So preparation and talking to a loan officer is very important.
That's very helpful. They need to know that up front and as quickly as possible, for sure.
Yes. You know, when you're going to make that offer with multiple offers on a house, you want to make sure that this person is ready to go on this because of the time that you have to write up a proposal, the time that they have to, talk to one another about it and start thinking about it, start dreaming about the house. You want to have all this stuff prepared before you go into it.
Great advice. Oh, one more question that was submitted. What are the lending options out there for financing a remodel, a renovation, or a fixer-upper?
The remodel, the fixer-upper, we call them rehab loans. Not every lender will do a rehab loan. Be prepared to not negotiate interest rate with these institutions that will do a rehab loan. You will find out that rehab loans carry a higher interest rate. And the reason for it is just simply all the people that are involved on the banking side to make sure you get the money that you need to do the rehab. A couple other things. On a rehab loan, you will not do the work yourself. You
Correct.
must be contracted. There has to be a contractor behind those fixer-upper projects. And the other part is you have two different type of loans. One is structural, one is non-structural. Both FHA and VA and conventional have these loans. But again, I reiterate, not every bank will do them. So you have to find somebody that does. Don't think you're going to negotiate interest rate, because those interest rates are what they are. So when they tell you what those interest rates are, that's what they are for that particular institution. But it will get you in the house. It will get the house the way you want it, according to the contracts, because you can't do the work yourself. And you can always refinance it after. It's really a construction loan. It's how construction.
So all of the people that want to do this have to realize that they can't do it because they're handy. They have to get other people involved in this.
That's
and
where
they
most
need
of them,
written bids.
Yes, you're absolutely right, dear. That's where most of them will say, nah, never mind, because they think they're going to get the extra money to do the work themselves. No banking institution will do that. When will the work get done is what they look at. There's time frames on these things. So, there's a whole department. You got to find a lending institution that has these to offer, and there's a whole department. And this department will be on everybody to get this work done, because the bank wants that property finished.
Got it. Good. Well, I want to thank you again. It was great having you answer all these questions. You're the consummate professional and the kindest person in the world. So thank you so, so much.
Oh, I thank you. Bye.
Bye.